There is a combination of tax consequences that could cost a senior homeowner $75,000 when they sell a home they have owned for decades, not because they cheated, not because they hid anything, because of one innocent family decision that most people have never even heard of. And here at Senior Updates Hub, Floyd has seen this exact situation play out more times than he can count. Good people, responsible people, people who did everything right their whole lives, blindsided by a tax bill they never saw coming. Floyd knows a woman in Ohio who found out the hard way. She owned her home for 34 years. She sold it last year expecting to pay nothing in taxes. She had lived there her whole adult life, raised her kids there, paid it off years ago. A clean sale, a fresh start. She owed $23,400. And the decision that caused it? She made it at her kitchen table on a Tuesday afternoon thinking she was being responsible, thinking she was protecting her family. It took her less than 10 minutes. If you are over 60 and you own a home, April 15th is the deadline that determines whether you can fix this quietly or deal with it the hard way. And Floyd means that exactly as seriously as it sounds. He is going to tell you exactly what she did and why it matters for you right now. But before we get into it, a quick note. Everything Floyd covers today is based on current IRS rules and federal tax law, including the One Big Beautiful Bill Act signed into law on July 4, 2025. Nothing in this video is a substitute for advice from a licensed tax professional. Use it as a starting point, not a final answer. Here is what this video covers. 4 traps. 4 completely ordinary homeowner decisions that are quietly creating IRS problems for seniors right now. Then, 3 things that could actually put money back in your pocket on your 2025 return that most people over 60 have never heard about. Then, a 7-step action checklist, including a free tool on the IRS's own website that shows you exactly what information they already have on your property. Most people only ever find out about the traps. Very few find out about the money they are leaving on the table. By the end of this video, you will know both. Do not leave early. The 4 traps spell out one word, home. H is for home equity mistakes. O is for ownership and deed changes. M is for move-out timing before a sale. E is for extra income from the home. Before we go further, if this is helpful today, please hit the like button and share this with anyone in your life who is over 60 and owns a home. That one share could save someone thousands of dollars. The people who need this most are usually the last ones to find it. Now, let Floyd finish her story. Her name is Margaret. She is a fictional composite drawn from real situations tax professionals see regularly. Every person Floyd mentions in this video is the same. Real consequences, composite characters. Margaret's husband passed away a few years ago. Her daughter Sarah stepped up after that. Groceries, repairs, doctor appointments, everything. One afternoon, Margaret's neighbor mentioned that adding Sarah to the deed would make things easier later. Avoid probate. Keep the house in the family. It sounded like common sense. So Margaret did it. County Recorder's Office. Simple form. No attorney, no tax professional. No reason to think twice. Here is what nobody told Margaret. When you transfer partial ownership of your home to another person, even your own child, the IRS can treat that as a taxable gift. Depending on the value transferred, that may trigger a reporting requirement on Form 709. And when the home is eventually sold, the person you added to the deed may not qualify for the same tax exclusion you do because they never lived there as their primary residence. Margaret found out 2 years later when her tax preparer looked at her return and said 4 words she was not ready to hear. We need to talk. Every dollar of that bill was preventable. The IRS does not care why you did something. It only looks at what you did and whether it was documented correctly. Good intentions do not show up anywhere on a tax return. So let's get into the H trap, home equity mistakes. Stay with Floyd here because this is where most people's eyes glaze over. And that glazing over is exactly what costs them money. Most homeowners believe that if money came from their house, it must be connected to the house for tax purposes. That assumption is wrong. Full stop. A senior borrows $40,000 or $50,000 against their home through a HELOC. They use it to help a grandchild with college, cover a medical emergency, or pay down debt. And because it came from the house, they assume the interest is deductible. It is not, unless the money was used to buy, build, or substantially improve the home securing the loan. That is the rule under the Tax Cuts and Jobs Act of 2017. If the money went anywhere else, that interest is personal interest, not deductible. And claiming it incorrectly creates a gap that the IRS's automated systems are increasingly good at finding. Think back right now. Did you take out a home equity loan or open a HELOC in the last 3 years? Where did that money actually go? Into the house or somewhere else? If it went somewhere else, you need a conversation with a CPA or enrolled agent before April 15th. Because if that interest was handled incorrectly, there are steps available right now that become much harder after the deadline passes. And the O-trap is the one that causes the most arguments when Floyd explains it, because people hear it and immediately say, that cannot be right. That is just a family decision. Floyd hears that every single time, and every time he says the same thing back. That is exactly why it is so dangerous. A senior adds an adult child to the deed for estate planning, probate avoidance, or just because that child has been helping and it feels right. What feels like a family decision is also a tax decision, and those two things do not always want the same outcome. Think about the last 5 years right now. Has anyone's name been added to your property? A child, a grandchild, anyone? If yes, and no gift tax return was filed that year, keep listening because this next part is specifically for you. When you add someone to your deed without them paying fair market value, the IRS can classify that as a taxable gift. When the value transferred exceeds the annual exclusion limit, a Form 709 gift tax return is generally required depending on the structure of the transfer and your specific situation. If that was never filed, that is a documentation gap sitting quietly in your history. And when you eventually sell, the person you added to the deed may not qualify for the primary residence exclusion, the rule that lets most homeowners exclude up to $250,000 in capital gains, or $500,000 for married couples, because they never lived there. Their share of the gain may be fully taxable. A sale that should have been tax-free becomes partially taxable over a deed change that took 10 minutes. Floyd has talked to seniors who found out about this at the closing table. Not before the sale, not during the listing, at the closing table, papers already in front of them. That is when they heard it. There is also the basis issue. If you transferred the home entirely as a gift, rather than leaving it as an inheritance, the recipient gets your original purchase price as their cost basis, not today's value. If you paid $80,000 and the home is worth $380,000 today, they could owe capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to current market value, and that gain would largely disappear for tax purposes. One path costs the family nothing. The other costs them tens of thousands. The only difference is the timing of the transfer. Now that is the specific reason April 15th matters more than people realize. The IRS has an automated system called the Automated Underreporter Program. It cross-references your tax return against third-party data, mortgage servicers, rental platforms issuing 1099-K forms, and property-related records. The gap between what you reported and what the IRS can see has been shrinking for years. Tax professionals are seeing more automated notices and more matching discrepancies than at any point in recent memory. After April 15th, if something has not been addressed, interest starts accruing automatically. penalties stack. And the first-time penalty abatement program, a real documented IRS policy that allows taxpayers with a clean compliance history to request significant reduction or elimination of certain penalties, becomes harder to use once assessments are finalized. The earlier you act, the more options you have. Now the M trap, move-out timing. This is the one that hits seniors hardest, and it is the most misunderstood rule in residential tax law. Under IRS Section 121, to exclude up to $250,000 in capital gains from your home sale, $500,000 if you are married filing jointly, you must have lived in the home as your primary residence for at least 2 of the 5 years immediately before the sale. That is the 2 out of 5 rule. Here is where it quietly destroys people. Floyd wants you to picture your own home, your own address, and think about where you have been living for the last 3 to 5 years. You move in with your adult kids because of a health issue, or into a smaller place while your house sits on the market, or you start renting it out while you wait to sell. All of these are understandable decisions. All of them affect your residency calculation. Say you moved in with your daughter in January 2021. You kept the house, tried to sell, could not get the price, rented it for a year, and finally sold in March 2026. You moved out January 2021. Sale closed March 2026. That is more than 5 years since you last lived there. Under the 2 out of 5 rule, you may not qualify for the exclusion at all because both qualifying years fall outside the 5-year look-back window. If the house gained $200,000, you could owe capital gains tax on the full amount. For most homeowners in this income range, that is roughly $30,000. Not because you did anything wrong, because retirement circumstances and a tax timing rule collided in a way nobody warned you about. There are partial exclusion provisions under Section 121C for health-related moves. They are real, but they require documentation and do not apply automatically. And here is something Floyd wants you to hold on to, because Dorothy's story in just a few minutes shows exactly what happens when this trap combines with the next one. If you have moved out of a home you still own and plan to sell, count the months this week. The window to address this exists right now. And now the E trap, extra income from the home. This is the one people dismiss first because the amounts feel small. That dismissal is exactly what makes it expensive. A senior rents out a spare room, maybe through a short-term rental platform, maybe just to a college student, maybe a family member pays something modest to stay in the basement apartment. It covers the utilities. It feels like a practical arrangement. But the moment your home generates rental income, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that income must be reported on Schedule E. Informal arrangements are not exempt. No formal lease does not mean nothing to report. Second, a portion of your home expenses become potentially deductible against that rental income, but without documentation, you either face audit exposure or you overpay. Third, if you later sell the house, the rental portion may not qualify for the primary residence exclusion. The gain gets allocated between residential and rental portions. The rental portion can be taxed as a capital gain, and depreciation recapture under Section 1250, taxed at up to 25%, can apply to the rental portion even if you never claimed depreciation in the first place. That spare room you rented for $600 a month for 2 years can affect the tax treatment of your entire home sale. Not just that room, the whole transaction. Now, Dorothy. Dorothy is 68, lives in Tennessee, and has lived in her home for 27 years. In 2022, a health scare pushed her to move in with her son, Michael. Temporary, she told herself. To cover expenses while she waited to sell, she rented the house to a young couple for a modest amount. She did not report it the first year because her accountant had just retired and the software she used did not ask the right questions. The following year, Michael added his name to the deed just in case Dorothy's health got worse. No gift tax return was filed. Early 2025, Dorothy sold. 27 years of ownership. She walked into that closing expecting a clean, essentially tax-free sale. The IRS determined she had moved out more than 2 years before the sale. The rental period had changed part of the home's classification. The deed change created a gift reporting gap. The unreported rental income was a separate liability underneath all of that. Dorothy owed $23,400 across 3 separate issues, none of which she knew existed when she made the decisions that caused them. She was not negligent. She was not hiding anything. She was a 68-year-old woman managing a health crisis, a housing transition, and a family situation simultaneously without anyone telling her what she needed to know. Dorothy did not fail the system. The system failed Dorothy. But the system does not adjust itself based on that fact. That is the whole reason Senior Updates Hub exists. Floyd wants you to know what Dorothy did not. Take a second and sit with that. Because what comes next is genuinely different from everything covered so far. And most people watching this are going to wish they had known it sooner. Now the other side of this, because everything so far has been about problems, the next few minutes are about money you may be leaving on the table right now. Real money, verified by the IRS, available on your 2025 return. The first is brand new, and most preparers are not flagging it automatically. It is called the Senior Bonus Deduction, and it is part of the One Big Beautiful Bill Act, signed July 4, 2025. If you are 65 or older, you can now claim an additional $6,000 deduction on top of whatever you already deduct. Whether you itemize or take the standard deduction, it stacks on top of both. Married with both spouses, 65 or older, that is $12,000 total, available for tax years 2025 through 2028. It phases out starting at $75,000 modified adjusted gross income for single filers and $150,000 for joint filers. For many seniors in the zone where 50 to 85% of Social Security is taxable, this deduction pulls taxable income down enough to reduce that exposure. It will not eliminate Social Security taxation entirely, but it can meaningfully reduce it. For many seniors, that is $1,000 to $2,500 in real savings. This provision was buried in an 100-page bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the One Big Beautiful Bill? If they look confused, find someone who does not. The second is the SALT deduction increase. From 2017 through 2024, the state and local tax deduction was capped at $10,000. For homeowners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone often exceed $10,000, that cap was painful. You paid the taxes. You got no deduction for the excess. As of 2025, that cap is now $40,000. For 2026, it rises to $40,400, increasing 1% per year through 2029. The phase-out starts at $500,000 in modified adjusted gross income, well above where most retired homeowners sit. Here is the problem. When the cap dropped to $10,000 in 2017, millions of homeowners switched to the standard deduction and never looked back. 8 years on autopilot. The cap has quadrupled. Their habits have not changed. If your property taxes plus state income taxes exceed $10,000, run the numbers again. Add your total SALT to your mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing. If you already filed using the standard deduction when itemizing would have saved you more, you can amend within 3 years. Do not leave that money sitting there. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, the 30% Federal Residential Clean Energy Credit is still on your return for that installation. The One Big Beautiful Bill eliminated this credit effective December 31, 2025. Systems installed and operational by that date still qualify. Systems installed January 1st, 2026 or later do not. The IRS has confirmed the cutoff is based on when installation is completed and the system is placed in service, not when you signed the contract or paid the deposit. If you have a 2025 installation and have not yet filed, make sure that 30% credit is claimed. On a $30,000 system, that is $9,000 you do not want to leave behind. For future upgrades in 2026 or beyond, that federal credit is gone. Some states still have their own programs, but the 30% federal credit that millions counted on is no longer available for new installations. Now, this last one is different. It is not about your tax return at all. It is not about something you did wrong. It is about money leaving your bank account every single year right now that you may be able to stop today with a 20-minute phone call. Almost every state in America offers a property tax homestead exemption for seniors. These are not small discounts. In Texas, the over 65 homestead exemption alone can reduce your home's taxable value by $60,000 or more on top of the standard homestead exemption, saving some homeowners $4,000 to $6,000 every single year. Florida freezes your property tax assessment at the value it was when you first qualified, meaning even if your neighborhood doubles in value, your property taxes do not go up. Georgia offers full exemptions from school taxes for qualifying seniors. New York, Pennsylvania, Ohio, Illinois, almost every state has a version of this. Here is why this should make you genuinely angry. These exemptions are not automatic. Nobody sends you a letter when you turn 65 saying your taxes just went down. You have to apply. You have to go to your county assessor's office or appraisal district, fill out a form, show proof of age and residency. If you have been 65 or older for years and never applied, you have been overpaying. Some states allow retroactive applications going back 1 or 2 years, meaning you could get a refund on taxes already paid. Call your county appraisal district this week. Ask what senior property tax exemptions are available. Bring your ID and your deed or a recent tax statement. It takes about 20 minutes. And for many people watching Senior Updates Hub right now, that call will save more money over the next 10 years than anything else covered today. Before the checklist, 60 seconds on something that has nothing to do with taxes. It has to do with protecting yourself from people who will use everything you just heard against you. Every tax season, scammers target senior homeowners aggressively. Phone calls, emails, people pretending to be IRS agents saying you owe money right now and will be arrested if you do not pay by wire transfer or gift card. The real IRS does not call you demanding immediate payment. The real IRS does not accept gift cards or wire transfers. The real IRS does not threaten arrest over the phone. The real IRS communicates through official postal mail with a notice number in the upper right corner of every letter. If anyone contacts you claiming to be the IRS and creates urgency around immediate payment, hang up, delete it. Report it to the IRS phishing hotline at irs.gov. The issues in this video are real. The people trying to exploit your fear about those issues are also real. Know the difference. Now, the action checklist. 7 steps this week. Step 1. Pull your last 3 years of tax returns. Look at Schedule A for mortgage interest. Look for Schedule E. Rental income lives there. Look for any 1099 connected to the property. Anything missing or unexpected, write it down. Step 2. Find your deed. Your county recorder's office can provide a copy online for a small fee. Check every name listed. If a name was added in the last 5 years and no Form 709 was filed, that needs professional review before April 15th. Step 3. Map your residency timeline. If you have moved out of a home you still own, calculate how many months since you last lived there as your primary residence. If that number is at or past 24 months and you have not sold, get professional review before the sale closes. Step 4. Check your IRS account transcript at irs.gov. Create a free account. It takes about 15 minutes. You will see every notice on file for your account and every piece of third-party data the IRS has matched to your Social Security number, including 1099-K data from rental platforms. If the IRS has information about your property that does not match your return, you will see it there. Knowledge is the only thing that gives you options. Step 5. Track your home equity records. Find documents for any HELOC or home equity loan. Write down exactly what those funds were used for. If they went into the house, you likely have a clean paper trail. If they went somewhere else, your return may need review. Step 6. List every rental arrangement the property has had. Any amount, any arrangement, dates, and amounts. A tax professional can tell you what was handled correctly and what needs to be addressed. Step 7. Contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Search by location and specialty. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate issues. That one question tells you immediately if they are the right person. Dorothy did none of these 7 things. Not because she was careless, because nobody gave her this list before she needed it. You have it right now. Use it. The cost of a professional review is almost always smaller than the cost of the problem it was supposed to prevent. Let's bring it all together one final time. The 4 home traps. H. Home equity. Money from your house is not automatically treated the same as money spent on your house under IRS rules. O. Ownership changes. Adding someone to your deed is a tax event whether you intended it to be or not. M. Move-out timing. The 2 out of 5 rule does not pause for retirement or health transitions. E. Extra income. Rental income from your home changes its tax classification, and that change follows the property all the way to the sale. And the 4 things working in your favor right now. The $6,000 senior bonus deduction available on your 2025 return. The SALT cap at $40,000 if you are in a high-tax state and still on standard deduction autopilot. Run the numbers again. The 30% energy credit for 2025 installations that have not yet been filed, and the senior property tax homestead exemption sitting unclaimed at your county appraisal district that could save you thousands every single year. If even one of the 4 traps sounded familiar, do not file this away as something to think about later. That is exactly how Margaret ended up hearing those 4 words. That is exactly how Dorothy ended up owing $23,400 on a sale she expected to be clean. Start with step 1 tonight. The deadline is April 15th. By then, what could have been a quiet fix becomes a scramble, and scrambles are expensive. If this video helped you, hit the like button right now. Subscribe to Senior Updates Hub if you are not already here. Share it with anyone over 60 who owns a home. And drop a comment below. Which one of these did you not know about before watching? That question genuinely helps Floyd decide what to cover next. And your answer might be the topic of the next video. In the next video, Floyd is going to walk through Form 709, the gift tax return that most seniors never filed when they changed their deed, and show you exactly how to address that gap before it becomes a formal IRS notice. If Margaret's situation sounded familiar when Floyd told her story at the beginning of this video, that next video is specifically for you. It is already on your screen. Watch it now, because this is exactly the kind of topic where waiting costs you more than acting.